So let's start this session without any delay. So first of all, let's talk about financial statements. See, every organization like Reliance, Tata, yes, Birla, Ambani's, all they are running their companies. But if they want to know about their profitability, if they want to know about their profitability, about their position, about their expenses, about their losses, yes, their expenses, etc. etc. So, how they are going to check it? Every time they are not going to open their journal book, they are not going to open their ledgers. Even if this type of companies, if they want loans, so can you tell me which is the document as a banker you are going to ask? Of course, income tax statement. Yes, you will ask about balance sheet. Why you are asking balance sheet and profit and loss account? Because this gives the clear idea about this companies, whether they are earning profit or whether they are in a loss. So with this statements, you are checking their profitability or they are into a loss. Correct? So already we have understood how to prepare this with the help of journal, ledgers and trial balance. But every time if they are preparing their accounts, they need to follow some standards. Like in banks, you are following that for reporting purpose to RBI, for reporting purpose to income tax. Yes, for reporting purpose, we require some standard formats. Correct? So for that, we have company accounts 2013. As per that, they have already given under this financial statements about these five important things. That as a company, you are going to pass journal, ledger, but at the time of reporting, at the time of closing of your financial year, you need to prepare this financial statements. And if as a company you want loans, if you want any subsidy or if you want to apply for any tenders, you require this statements. So financial statements includes five things. Number one, that is your balance sheet, profit and loss account, cash flow statement, statement of changes in equity, and explanatory note. See, balance sheet talks about position. Yes, about financial position. And especially we prepare balance sheet for any particular date. Yes, not for whole financial year we are preparing. No, for any particular date you are going to prepare this. And generally we prepare balance sheet on 31st March. Yes. Then next is your profit and loss account. Through this you can know about the profit or loss whatever earned by the company, and this is prepared for 12 months. That during the period, what are your expenses, what are your incomes, based on that you calculate profit and loss account. Then cash flow statement. Now cash flow means what? See, this is a very neutral term, cash flow. Why this is a neutral term? Because suppose here is your Reliance Industries. Reliance Industries, they are selling the product, and for selling the product they require purchasing of raw material. So if they are selling the product, customers are paying the cash. Yes, yes or no? So this will lead to, for this organization, inflow. But in case of purchasing from suppliers, they need to pay. So this time when they are paying to the suppliers, this will lead to outflow. Correct? So cash flow includes both the things, inflows and outflows. So this will include both the things. So we have one particular unit in which we talk about cash flows. So generally in that we are talking about only and only when there is actual cash flow. no credit transactions we are recording. No credit transactions. Only when real cash flow is there, then only we are going to talk about it. The next is your statement of changes in equity. So, as an investor, when you are investing in any companies, so during the financial year, companies are maintaining this data, opening shareholders, if any new shares during the year they have introduced, or if they have done any buyback. So, all these things they are recording in this statement. And finally, they are closing this. So, this is financial statement. Under that, this is the fourth thing that companies are preparing. But not every company is preparing. Okay, only if that is applicable for you, then only you need to prepare it. And this is statement of changes in equity. Last one, that is explanatory note. Now this is very important. Now explanatory note talks about whatever you have mentioned in your balance sheet. Suppose in balance sheet you are showing loan. Yes, only loan, and that amount you are going to show, suppose 10 crores. Only this is you are showing. But if you want to give any extra information, if as in company you want to give any extra information related to that loan, or suppose in future someone means currently someone filed uh, case, yes, court case on you. Currently someone filed court case on you, and because of court case you might see in future some liability. So you need to mention these things in your financial statement, and how you can give this disclosures through this notes. Correct? So this is just a extra space for clearing your points, because as a company you need to disclose, you need to be transparent. Correct? So these are the five different financial points under the financial statements. Again, I am repeating: balance sheet, profit and loss account, cash flow statement, statement of changes in equity, and explanatory notes. See, let me tell you one more thing related to this only. We have one term, that is final accounts. So till previous units, you must have seen preparation of final accounts. Yes? So what is this? Again, this talks about your balance sheet and just profit and loss account. Only these two things. But when we talk about financial statements, this includes five things: balance sheet, profit and loss account, then your changes in your cash flow, then statement of changes in equity, and finally notes. So these are the five different things you need to maintain under financial statements. So that is the only difference between final accounts and financial statement. Now I hope you can remember this, because this is very important from the exam point of view. Then, though we have already seen that financial statements we need to prepare, five different accounts we need to prepare, and we need to follow Companies Act 2013. Correct? But we require format. What Reliance company, what Tata company, what this uh, Birla company, or any type of company, whatever they are, you know, preparing for balance sheet, they require some format. Yes, and how they can get that format? Through this schedule 3. That's why whenever you are taking documents for loan purposes, you might observe that overall the format is similar. Yes, like A company's format is going to be similar with B companies, C companies, because things are standardized. Otherwise, we have different managers, we have different finance department, so they will prepare according to them, and this will lead to confusion. So to avoid the confusion, Companies Act 2013 already prescribed you the format. Under which schedule? Schedule 3, which talks about balance sheet and profit and loss format, like how to prepare it, so that at least basic standard format you all must have. Like say in banks, when as a customer, if I visit and if I want suppose account opening form, so already you have a standard format. Yes, you will provide me that document. Or if I want to withdraw some amount from bank, so again you will tell me that ma'am, there is that withdrawal form, please fill that form. Correct? If I want to start any saving, again you will tell me ma'am, this is the form, please fill this form. Why? Because you want things to be standardized. See, if there are 1,000 customers they are visiting in just a single day, and if each and everyone they are writing by their own, and everyone wants to open their account in that particular bank, but things are going to be different. Yes, so to make it standardized, like in your banks, same in accounts, while we are preparing, we have some standards. For that, we need to follow Schedule 3. But remember, when we talk about like this banking companies, insurance, or any company engaged in generation or supply of electricity or any other class of company, if they are required to follow any special act, like for banking companies, we have Banking Regulation Act. Yes. So, first of all, you need to follow that Banking Regulation Act. For insurance, we have their own act, IRDA Act. So, first, follow that specific act. If in that specific act anything is prescribed for this preparation, then you need to follow first that act. If nothing mentioned, then you can take the help of Companies Act. Companies Act is a very wider, you can say, you know, area covers. But if something is very specific for any specific sector, then you need to follow that specific act first. And which are the companies which have their own specific act? Like A, banking company, B, insurance company, C, company engaged in generation or supply of electricity. Or if any other class of companies, if any specially mentioned or specified to you. Yes, so this is about financial statements. Now, coming to the next one, financial year. You all know about this. Yes. So, when you are closing your books on 31st day of March, not only your bank, every businessman, everyone is closing on 31st day of March, and you are starting 1st April. This is your opening. Yes, this is a new financial year, and 31st March, this is closing. Correct? So everyone knows about this. Everyone knows about this. In India, we are closing our books on 31st March. This is a very common point. Everyone knows. But the important point here is this, B1. Now, you know, in our previous unit, we have seen about registration. Correct? If you want to start your company, you need to take registration under Companies Act 2013. Yes or no? So when you are registering your company, or you can say when you are starting, if I say in a very simple word, if you're starting your company, so if you're starting before 31st December, and then you have after 31st December. These are the two timelines that you need to see here. If you are starting your company, you are getting registration before 31st December. Yes, suppose this is your 31st December 24. In case you are registering during this time period, means from 1st April 24 till 31st December 24. If you're registering within this time period, you are going to end your financial year on 31st March 25. Yes, this is the point. Now, next is if you're registering after 31st December, means you are registering 1st January. I'm taking the same 31st December 24. If you're registering from 1st January, yes, you are registering from 1st January 25 till 31st March 25. If during this three periods if you are registering, so your end of that financial year is not going to be 31st March 25. You are not going to close your books on this date, 31st March 25. You are going to close your book on 31st March 26. This is the point given in your B, and this is very important. Yes, and remember, in case where company or body corporate is a holding company or a subsidiary of a company incorporated outside India, you are required to follow different financial year. Generally in India we follow 1st April to 31st March. But if you want to follow 1st January till 31st December, means calendar year, then you need to take the permission. What you need to take? You need to take permission. And who will allow this? Tribunal. Who will allow this? Tribunal. And that is your financial year. Correct? Every year you need to close on 31st March. That is very basic point. Important point is if you are registering on or after 31st December, means 1st January or after 1st January, your ending of that financial year is going to be following year, not that same year. Correct? So this is about the financial year. But now if you want to follow any different year, time period, any different financial year, then you need to take the permission from tribunal. So these are the three important points under financial year. Now, let me tell you about form of balance sheet. So this is the schedule 3 which prescribes the form of balance sheet. So part 1 talks about the balance sheet, part 2 talks about your profit and loss account. You need to write the name of the company, balance sheet as at like which particular day you are preparing. Like suppose you are preparing for 31st March 2025. Okay. And you are suppose Reliance company, and as per that you are following. So you need to start with first liability side. See, this type of format is known as vertical format. Yes, this is a vertical format. So you have a particular side, then you have notes, note number. If you want to give any detail, so you can use this note number, and for the reference you need to check then explanatory notes, that fifth point from your financial statement. Then you are going to use two types of more columns, like first figure at the end of current reporting year, that is 25. Yes, so whatever happened from 1st April 24 till 31st March 25, you're going to record it here. And the next column, that is your previous reporting period column, means your 1st April 23 to 31st March 24. Basically here you are creating comparison. Yes, comparison. Okay, so this is your current year, this is your previous reporting period. So you start with the liability side, equity and liabilities. So different types of share holders we have, so all about that we need to write it here, like your nominal share, then issued share, paid up capital, yes, forfeiture, everything. You need to write it here. Reserves and surplus like your general reserves, capital reserve. Yes, all these things you need to record it here. Then share application and pending allotment, if there is, you need to record it here. Then non-current liabilities. Whenever you see non-current liabilities, means the liability is going to be more than 12 months. If the time period is more than 12 months, that is going to be non-current liabilities, like long-term borrowings, like you have taken house loan. Yes, that home loan you have taken, or vehicle loan you have taken. So you need to record it here. Then deferred tax liability, other long-term liabilities and long-term provisions. Then current liabilities, if the time period of the liability, that obligation, is less than 12 months, you need to record it here. Like if you have taken for 6 month debt or 2 days borrowing, whatever that can be. So if that is less than 12 months, you are going to record in this current liabilities. And finally, you can see here you need to total it. And always remember, your total of liabilities plus capital is going to be equal to what? Assets. Already you have seen this, yes, in your balance sheet equation. So the basic, this equation we are following in each and every time, yes, whenever you are going to talk about balance sheet. Now next, assets. What next we need to talk about? That is about assets. Assets means you have some control plus ownership. Yes. So first, non-current assets. Again, same. If your assets life is more than 12 months, like you have purchased tangible assets, that is your machine, building, plant, factory, etc., etc. So if you're going to use for more than 12 months, you're going to record it here. Intangible assets like your patent, yes, copyright, all these things. Capital work in progress means their work is going on, like you are doing research and development expenses. So you need to write it here. Same goes for your intangible assets. Then non-current investments like you have purchased gold, yes, silver, or you have invested in other companies. So suppose if you are preparing this this balance sheet for Reliance Industries, yes, you are preparing this for Reliance Industries. So now if you are investing in other companies like Tata, then that is your asset. Yes, you have purchased shares of Tata, then you need to record it here. Deferred tax asset, long-term loans and advances, and non-other assets. Next column is going to be, next part is going to be your current assets. Now current assets meaning is life is less than 12 months. Correct? If life is less than 12 months, then record it here, like your current investments, inventories, trade receivables, cash and cash equivalents, short-term loans, advances, and other current assets. And again, you will add both the sides, that is your non-current and current asset. And you can say this is your total amount. Yes. Now this total amount of your assets needs to be, tally with this liabilities and capital amount. So this is about the form of balance sheet. And remember, this is very important from the exam point of view. So we have covered all the important things.
So first of all, we need to understand what is this cash flow, because without understanding this, you cannot adjust the transactions. Yes. So let's start with the first thing, that is cash flow. Okay. So if I talk about any organization, yes, suppose this is your Reliance Industry. Now in Reliance Industry, we know they are going to sell, yes, whatever they are manufacturing, whatever services they are providing, they are going to sell to their customers. And here is your customer. So now in return, customer will pay, yes, customer will pay in cash. Yes. So what is this flow known as? This flow is known as inflow. Yes, there is a flow of cash from customer to Reliance Industries. Now, if I take one more example, this is again Reliance Industry. Now, for manufacturing, Correct? For manufacturing, this Reliance Industries must be purchasing from different suppliers. What they are purchasing? Raw materials. Yes, and if you are purchasing raw materials, Reliance Industry needs to make payment. And when they are making payment, there is again going to be cash flow. Yes, without paying, no one is going to transfer you any products, whether that is your raw materials or whether there is your customers. So there is a very important, you can say, factor through which your transaction completes. That is your cash. Yes, every transaction denotes your monetary value, and in that there are two ways of your cash flow. One, if you are paying, that is outflow. One, when you are getting, that is inflow. So as soon as you are receiving your salary in your account, that is what? That is inflow for you or outflow for you? Of course, inflow for you. Yes, when you purchase any goods, suppose TV, furniture, vehicle, that is what? That is cash inflow for you, or you are paying to someone, so that is cash outflow for you. Of course, that is cash outflow. And that is the meaning of cash flow. Again, I am repeating. So, whenever you are receiving cash, that is cash inflow. Whenever you are paying cash, means cash is going outside, that is going to be cash outflow. Same, this concept works in organization, like your Reliance, yes, Tata Group, this every type of companies, like in your bank also, this cash flow is there. So this is the meaning. Now let's read the theory part. So cash flow is the movement of money into or out of a company over a certain period of time. And generally, when we talk about time, you already know now that when we talk about this period of time, we are following financial year. Yes, we are following financial year. Financial year already you have covered in your company's account 1. So in that, you need to prepare your book from 1st April to 31st March every year. Correct? So period of time generally is our financial year, which starts from 1st April and ends on 31st March. So this period, whatever cash inflow is there, whatever cash outflow is there, we are going to record. What we are going to do, we are going to record it. Yes. So if the company's inflows of a cash exceeds its outflow, its net cash flow is positive. Means what? Whatever inflow, means suppose you have received during the year 5 lakhs. Yes, from sale you have received rupees 5 lakhs, and during the year suppose you have made expenses of around 4,50,000. Rent payment, electricity payment, yes. So all this expenses, if you combine it, that is around 4,50,000. So this is your outflow. So if you subtract this 5 lakh minus 4 lakh, this will give you 50,000. And this 50,000 is going to be your net cash, which flow? Inflow or outflow? Inflow. Okay. So this is about your cash flow. Now, when we talk about any business, we are dividing this cash flow into 3 different activities. Number 1, A, that is operating activities, B, investing activities, and C, financing activities. Yes, we have 3 types of activities: operating, investing, financing. Now, how to classify that this cash flow is your operating, or this cash flow or transaction is your investing, or this cash flow or that transaction is your financing? So one by one we are going to talk about it. So let's start with the first one, that is your operating activities. Now, suppose if I'm starting furniture business. Furniture business. So can you tell me what is my core business? What is my core business here? If I'm starting furniture business, so what is my main objective of this business? To purchase mobile phone? To sell vehicle? No. What is my core business? Purchasing, selling of this furniture. Yes. Okay, so this is your example 1. Now, example 2. If I am manufacturing this time cars, so tell me, what is my core business? My core business is purchasing and selling of land, purchasing, selling of computers. What is my core business here? Purchasing, selling of what I can say here, let's say pen or stationery items. Or my main business, my core business is going to be selling and purchasing of these cars. Of course, Hana. So you can see here, whatever business you are starting, you have some main business, you have some core business on which you are going to do your daily transactions. Yes. So when we are talking about this operating activities, means we are talking about your daily activities. And if you see these two examples, your daily activity is what? Purchasing and selling of furniture, purchasing and selling of cars. So that is going to be my operating activities. Means for daily business, whatever expenditures, incomes I am incurring, that will lead to operating activities. So basically you can say for running your business, whatever expenditure or whatever income you are generating from sale, from purchase, that will lead to operating activities. So this particular activity is what? Principal revenue producing activities. Yes, this is what principal revenue producing activities of an entity. Now, operating activities, this consists of inflows. Again, see, cash flow when you are reading, cash flow includes your both the flows. Inflows, outflows, both the flows. Yes. So when we talk about operating activities, that will include inflows as well as your outflows of cash, which will be resulting from the firm's daily business, and through this they are going to earn profit or loss. So this is your operating activities. Always remember your daily business, your daily transactions. Yes. For example, cash, receipts from royalties, fees, commissions and other revenues, or when you're paying rent, that is also your daily activity. Yes, or everything will be included in your operating activities. So this is your first type of activities. So as you can see, Godrej, if we talk about Godrej, what is their main business? The main business is all these type of activities, correct? So this is their operating activities, correct, related to this air fresheners, soaps and hand washes, this different types of dishwash, everything whatever is included in that their main business is what their operating activities. Now coming to next, that is investing activity. Now investing activity means what? See, are you going to purchase table every day, vehicle every day, TV, furniture every day you are going to purchase? No. Yes, once in a 5 years, once in a 10 year you are going to purchase all these things. Yes, so it means you are investing somewhere, like you are purchasing gold, silver, you are purchasing land, you are purchasing building, you are purchasing vehicle. So you are purchasing assets which you are not going to purchase every day. Yes, and you will use these things for more than 12 months. And if you are doing so, then that is going to be classified under investing activities. So in this, when you are acquisition you are doing, like you acquisition for simplified version for right now you can understand as when you are purchasing. Disposal means when you sell, yes, of long-term assets, and we know long-term assets means more than 12 months, and other investments not included in cash equivalents, means other type of investments which are not your short-term investments, or you can say daily operational investments, that is not your main business. So that is your investing activities. So cash outflows represent that you are doing expenditure for acquiring, or you just think about, wait, let me give you one example. So tell me, when you're purchasing car is your business? No. You Your main work is what? You all are employees in bank. Yes, so your main business is you all are employees. But you are purchasing car, you are purchasing furniture. So that is your investment. Now tell me, when you are purchasing this car, so while purchasing this car, you are receiving cash or you are paying cash? What you are doing? You are purchasing car and you are receiving cash. Is it so? No. Correct? When you are purchasing car, you need to pay something. Yes, it's a two-way transaction. And every time you cannot be benefited. You are receiving asset also and cash also. Why they will give you this thing? Yes. So always remember, whenever you are purchasing, there is going to be outflow. In case of purchase. In case of purchase. Now let's take second example. Now this is one piece of land which belongs to you. Now you are selling to Mr. Y. Now tell me, you are Mr. A. Now tell me what will happen. At this point of time, you are selling this land. Yes, you are selling this land. You sold this land to Mr. Y. Now tell me, what you are going to receive. Just think as a practical. What you are going to do. If you are selling me your land, yes, so what you are going to receive. You are only going to give me cash, or here I am going to pay you something. Correct? I am going to pay you something. Means if I am selling, if I sold you this land, I will receive cash. Then only transaction will be completed. Na? So in this case, when you are selling something, there will be inflow of cash. Yes, so this is about your investing activities. There will be cash inflows when you sell and cash outflows when you purchase. Now, for example, cash payments to acquire property, plant, equipment, intangibles like trademarks, copyrights. Yes, all these things included in your intangibles. So these payments include those relating to capitalized developments, cost and self-constructed property, plant and equipment. So this is about your investing activity. So whenever you are purchasing, selling land, building, equipment, machine, computer, furniture, anything which you are going to use for more than 1 year, and that is not your regular business, then you are going to classify in your investing activity. Yes, for example, you can see here like table you are purchasing, chair, yes, JCB, this shelf you are purchasing, this factory you are purchasing for your business. So all these investments will lead to what? Investing activities. Yes, now next, financing activity. So till here we have completed your two types of activities. Operating activity means your daily operations. Yes, includes your daily operations, and here you can see again cash inflow, outflow, and this will give you net profit or net loss. Yes, this is about operating activities, what we have understood. Now, investing activities means when you are purchasing or selling long-term assets. So whether you purchase or sell, this will lead to investing activities. Now, for example, land, building, car, furniture, yes, computer, etc. So that is your investing activities. Now, let's talk about last activity, that is your financing activity. Now, always remember, finance means funds. Yes, this finance means funds. So here we are going to talk about fund arrangement. Yes, here we are going to deal and we are going to see how you are going to arrange funds. Now tell me, if you want 10 lakh rupees, What are the options you have? Tell me. If I'm asking that you want 10 lakh rupees. Now, what are the options you have and how you can arrange this 10 lakh rupees? If you are holding any fixed deposit, you will say, ma'am, fixed deposit amount I have. Then you can say, ma'am, let's take bank loan. Yes. Or you can say, ma'am, let's borrow from my friends. Yes or no? Through this, you can arrange this 10 lakh rupees. Of course. Yes. So whenever we are talking about funds and what are the sources you have through which you can arrange the funds by your own saving or when you are borrowing, means we are talking about funds, and that is your financing activity. How you can fund in any business, how you can arrange funds in any business. Now let's talk about as a business point of view. Now suppose this is Reliance Industries. So Reliance Industries, how they can arrange funds? First of all, Ambanis can invest in this company. Yes. Or they can take public borrowing. Now this public borrowing means they can issue shares and through that they can raise, or they can issue bonds. Yes. Or how they can raise? Through loan. So these are the ways through which any organization can arrange funds. So this is about financing activities. Yes, so financing activities can be useful in utilizing the cash generated through operating of any investing activities, means how you can arrange funds. Yes, so this can also utilize for increasing cash inflows in times of need. So this is your last type of activity known as financing activities, like cash proceeds from issuing shares or other equity instruments, cash payments to owners to acquire or redeem the equity entity shares. So everything, when you are taking loan and when you are repaying loan, that will be included in your financing activity. Okay? So what we can conclude here, we can conclude for financing activities when you are arranging funds. Yes, when you are arranging funds. Now, at the time of arrangement, as well as at the time of repayment, arrangement, or I can say when you are borrowing plus when you are repayment, when you are doing repayment of any loans, that will be included in your financing activities. Means fund arrangement we are doing. Yes, how we can arrange the funds, own amount, borrowing, correct? So this is about 3 types of financing activities, and mostly when we talk about this financing activities, you can use your own saving, you can use from bank borrowings. Yes, you can take from your own profit, whatever profit you are earning, you can use that profit in your business, or you can issue stocks and bonds. So these are the different ways through which you can arrange funds. Now, let's start and solve few questions based on this. So for the purpose of preparing cash flow statement, which one of the following is considered as operating activity? A. Acquisition of machinery, B. Purchase and sale of goods, and C. Issue of debentures, D. Repayment of term loan. Tell me. So when we are talking about machine, means we are going to use this machine for more than 12 months. Yes, and this is going to be your investing activity. Now, if I talk about these two, the issue of debentures, repayment of term loan, means we are talking about funds. And when we talk about funds, that is your financing activity. Okay, so the correct answer is answer B. Purchase of goods for sale. Next, for the purpose of preparing cash flow statement, which one of the following is considered as investment activity? Investment activity. A. Buyback of shares, redemption of debentures, manufacturing of goods, disposal of machine. Now, manufacture of goods means here this is your business. Yes, or you can say this is your core operations. Now, when we talk about core operations business, that is your operating. Yes. So this is not your answer. Then, a buyback of shares and redemption of debentures means repaying of borrowed amount. Okay, if you don't know what is the meaning of shares and debentures, then understand it as a way through which you can arrange the funds. So that's why I'm writing as a borrowed amount when you are repaying. So that is going to be your financing activity. So here correct answer is disposal of machinery. So when you are purchasing machinery, that is also your investing, and when you are selling that machinery, that is also going to be your investment activity. Yes. Then next. The cash flow statement primarily provides information about what? Profitability of the company, financial position of the company, cash inflows, outflows of the company, revenue and expenses of the company. So see, profitability is given by your P&L account. Yes, financial position given by your balance sheet. Revenue and expenses, we have an income and expenditure account. So as per this, your correct answer is answer C. Yes, you can understand what are your cash inflows and what are your cash outflows. So correct answer is answer C. Now next, okay. Which of the following is included in operating activities section of a cash flow statement? Purchase of equipment, cash received from customers, issuance of shares, payment of dividends. They are asking that what you are going to include in operating activities. Purchase of equipment? No. This is your investing activity. Yes. Issuance of shares and payment of dividends. These both are your financing activity. Correct answer is when you are purchasing, selling on a daily basis. So your customers will pay you. So that will lead to operating activities. So correct answer is answer B. So before we know that under which part and how they are preparing their accounts, first let's talk about few introductory part. A banking company is generally governed by the provisions of the Companies Act 2013 and specifically by Banking Regulation Act 1949. See, banks, though they are accepting and they are providing loans, but they need to comply with Banking Regulation Act. Yes, RBI norms. Every time, every week, month, we are seeing so many amendments. So bank needs to follow those amendments along with Companies Act 2013. These are the two important acts for banking companies. Then we have some major institutes that carry banking business in India. We have nationalized banks, yes, State Bank of India, foreign banks having branches in India, then cooperative banks, regional, rural banks, then we have private sector, small finance, payment banks. So these are the different types of banks which are working in India. But what actually banks are doing, now let's talk about that. So, as per this section 5 of the Banking Regulation Act, here you can see bank accepts the deposit of money from the public. Yes, what is happening here? Here, bank is accepting deposits from public for the purpose of lending or investment. Yes, now bank takes the deposits from their customers, and when these customers require loan, bank is providing them loans also. So major feature of the bank is what? Accepting deposits and providing loans. And the deposits are repayable on demand or otherwise by check, draft, order or otherwise. So basically here we have seen the definition of bank. Yes, they are accepting and they are providing the amount to the required persons. Now, under this we need to comply with different sections. Like first one, that is section 29 given under your Banking Regulation Act. Now, as per this section, section 29, this gives the format in the schedule 3. Now, format for what? Format for your balance sheet, for your P&L account. See, final accounts includes two things. Yes, balance sheet as well as profit and loss account. These are the two things which are included in the final accounts. Now, when we talk about this final accounts, we have one prescribed format. That format is given under Schedule 3 of the Banking Regulation Act. Yes. Now, here this format is issued by RBI. Who issued this format? RBI. So Form A talks about balance sheet. Form B talks about profit and loss account. Yes. So every bank, when they are preparing their final accounts includes balance sheet, P&L, they need to comply with this Form A and Form B. Now, as banking companies, they needs to close their books on 31st March every year. Every year on 31st March, this banking companies needs to close their book. Yes, this is your section 29. Now, when we talk about signature on financial statements, because for taking the approval that yes, these documents are genuine documents, for that we require signature. Yes, from authorized person. Now, who are authorized? Who can sign on this financial statements? So, in case of banking companies incorporated in India, means what? See, this is our India. And if we talk about State Bank of India, yes, if we talk about any other banks like Axis Bank, not Axis Bank. Let's take the example of ICICI Bank. Yes, so they all are incorporated in India. So now when they all are incorporated in India, they are known as Indian banks. Now, who are allowed for signature on their financial statements? That should be signed by the manager or principal officer of the banking company. Yes, who will signed by the manager or principal officer of the banking company, and by at least 3 directors. For all the directors, in case number is less than 3. So now you need to take the signature from the manager or principal officer. Yes, you can take manager or principal officer, but along with that you need to take the at least 3 directors signature. And if directors are less than 3, you need to take all the directors signature. So this is about your banking companies incorporated in India. Next is your foreign banking companies like HSBC Bank. Yes, so they are incorporated outside India, but they are working in India. So the manager, agent of the principal office in India, who is managing that bank, yes, who is the principal officer of that bank, that person needs to sign on that documents. So we have 2 points under signature. Yes, in case your bank is formed in India, then you need to comply with manager or principal officer plus 3 directors signature. But in case your bank is foreign bank, then you need to take manager or agent of the principal office in India. So this is about signature on financial statements. Now, next part is section 30, again from Banking Regulation Act, which talks about audit. Now, first, banks will prepare their financial statements. Yes, they will prepare their balance sheet. Then they will prepare their profit and loss account. And after completion of that, only you will start your audit part. Yes, audit is what? Audit is examination of your documents. So when we are doing examination of the documents, here accounts must be audited by a person duly qualified under any law for the time being enforced to be an auditor of companies. If the candidate is having that eligible qualification, then they can start audit on that particular documents. Yes, so every banking company is, before appointing, reappointing or removing any auditor, required to obtain the prior approval of the RBI. Yes. So after completion of your financial statements by the bank, they need to conduct audit. And when they are doing this audit, yes, when they are doing this audit, they who can do this audit? Only the qualified candidates can do. Now, if banks want to appoint any new auditor, if they want to remove any existing auditor, or if they want to reappoint that same auditor, they need to take the prior approval from RBI. They need to take prior approval from RBI. So this is about audit. Audit is what? Audit is examination. Correct? So this is section 30, which talks about audit. Now, coming to the next section, that is section 31. Submit copies to the RBI. Now, first you have prepared your financial statements. After preparation, you will conduct audit. Yes, here qualified person will cross-check your documents. After audit, you need to submit your documents to your regulatory bodies. Yes, as per law. So here we need to submit to RBI. Submit copies to the RBI. Now 3 copies we need to submit. How many copies we need to submit? 3 copies. We need to submit 3 copies. Yes, 3 copies of what? Of balance sheet, profit and loss account. 3 copies of balance sheet and profit and loss account prepared must be submitted to the RBI, to the Reserve Bank of India. And in how many days? From the closing of your financial year, so within 3 months, you need to submit this copy to the RBI. Yes, from the end of the financial year, 3 months we have time. In that period, we need to submit to the RBI. So first, we have seen financial statements. Yes, in that you have form A, form B. Then next, you need to conduct audit. And after that, you need to submit documents to the regulatory bodies that yes, we have complied with your laws and regulation. So first, we are submitting copies to RBI as per section 31 of the Banking Regulation Act. Now here we need to submit how many copies? 3 copies. In how many time? In what time period? In 3 months from the end of your financial year. Yes, but if you want to extend this time period from 3 months, you can extend by taking the RBI approval for next 3 months. Yes, you can extend further 3 months, but remember, you need to take RBI approval that we want further 3 months again because we have not completed our audit or whatever reasons you have, and as per that RBI will give you extension. So this is section 31, submit copies to the RBI. Now, next we have section 32, submit documents to registrar of companies. First, you have submitted your copies to RBI. Now, next we need to submit to the registrar of companies. Yes, Ministry of Corporate Affairs. So now, this Ministry of Corporate Affairs incorporated your bank. So we need to submit, this banking companies needs to submit 3 copies. Yes, 3 copies of its annual accounts and auditor's report. Annual accounts, whatever balance sheet P&L you have prepared, and auditor's report. Yes, your auditor will provide you one report after completion of that audit. So you need to submit 2 things. What are the 2 things? Annual accounts and auditor's report. And how many copies? 3 copies. Correct? To the ROC, that is Registrar of Companies. That is what? Registrar of Companies. So this is about submit documents to ROC. Now in this you have rule 15. Now rule 15 is again important. As per this rule, you need to publish your auditors and your accounts report document on your local newspaper. Now what is that exact point? So whatever the accounts and report you have generated Yes, you need to publish. And publish where? You need to publish on your newspaper, which is circulating in a place where a banking company has its principal office. So, in which place you need to circulate this? In your principal office address, whichever is the newspaper is circulating, you need to submit those documents. Which two documents? Accounts plus auditor's report within 6 months. And what is the time period? From the end of the time period, you have 6 months time. In that time, you need to publish your accounts and auditor's report in that newspaper. And in which newspaper? Which is circulating in your principal's office. Not all over India. No requirement of that. Wherever you have your principal office, in that area, whichever newspaper that is circulating, use that and publish your accounts and auditor's report. And what is the time period? 6 months. Yes. So this is about section 32 and rule 15. Okay. So now let's start and solve few questions. Achha, before we start this, let's quickly revise the important concepts. See, these are very important. They can ask direct questions based on this. Yes. So the first we have seen about the introduction part. Then next we have started with the definition. Okay. Then section 29 talks about RBI issued form A balance sheet, form B P&L account. Then who will sign? In case of banking companies, manager or your principal officer. Along with that, 3 directors signature we require. And in case of foreign banking company, you can take the sign from manager or agent of the principal office. Yes. Then next is your section 30, which talks about audit. Now in case of audit, who can conduct this audit? Only the qualified candidates. Now in case of you are appointing, reappointing, or if you are removing any auditor, you need to take the prior approval from RBI. Then section 31 talks about submit copies to the RBI. 3 copies of balance sheet P&L to the RBI within 3 months from the end of your period. Now if you want to extend further, you can extend by 3 months. But remember, you need to take the permission from RBI. Correct? Next, section 32, submit documents to registrar of companies. Now, you need to submit documents to your Ministry of Corporate Affairs. So here also you need to submit 3 copies of your annual accounts and auditor's report. Now in case of rule 15, you need to publish accounts and auditor's report in your local newspaper, which is circulating in your principal's office area within 6 months from the end of period. Okay, chaliye. So let's solve few questions based on this. Okay. Banking companies in India are primarily governed by which of the following acts? Tell me. Companies Act 1947, Companies Act 2013, Banking Regulation Act 1949, or both B and C? Correct answer is both. Yes, B and C. Now, coming to next question. Under the Banking Regulation Act 1949, how many copies of balance sheet, profit and loss account must banks submit to the RBI? How many copies we need to submit to the RBI? 1, 3, 5, 10. Correct answer is 3 copies. Yes, 3 copies of what? Of your balance sheet plus profit and loss account. Okay. Then, next. As per Section 5 of the Banking Regulation Act, a bank accepts deposits of money for which primary purpose? Lending or investment, buying assets, distributing profits, payment of taxes. So tell me, a bank accepts deposits money for which primary purpose? For lending or investment. Lending or investment. Yes. Correct answer is answer A. Next. Under Section 29 of the Banking Regulation Act, what is the specified format for the balance sheet and profit and loss account that banking companies must follow? Tell me, A, B, C, D. You have 4 options. Form A, profit and loss account. Form B, balance sheet. No. C. Form A talks about balance sheet. Form B talks about P&L account. Yes. Form A, balance sheet. Form B, profit and loss account. Correct answer is your B.
So first, let's talk about what is computerized accounting. Yes. So, computerized accounting means what? An accounting system is one that performs the following function. First, it captures business transactions in the form of accounting entries. Second, accounting entries are then used to prepare financial statements. See, first, you are using your computers for passing daily entries. Now, daily transaction you can see like you are receiving cash. Yes, you are paying cash in your bank. Yes, loan or deposits. So daily transactions are there. You are recording that. Along with that, you are preparing your financial statements. Now, financial statements means what? Balance sheet, profit and loss account. Correct? You are using softwares only now. Then you are using this computers so that you can apply accounting standards, your rules and regulations related to your accounting. All the accounting standards in this you are using through this computer only. And if you want any different type of reports, yes, like you want report, you want your loan report, you want your interest report, easily you can generate with the help of these softwares. There is no requirement to pass same entries again and again. Yes. So if your if your computer is performing these type of activities, then you are going to say you have developed computerized accounting. Yes, this is the meaning of computerized accounting. If your computer can pass business transactions which you do daily, then your software or your computer can prepare financial statements. And these financial statements are complying with your accounting standards or index. And if you want any separate type of reports, you can generate through this only. Then that is your computer is your computer is developed for computerized accounting. So this is the mean. Now, computer components. So basically we can say we have physical components like hardware. Yes, then we have softwares, and then we have computer peripherals like supporting devices in your computer like printer, video monitor, keyboard, disk drive, etc. So these are the computer components. Then next is our computer language. See, like in accounting, we have sorry, in our business we have accounting language. Yes, like how to pass the entry, how to do the entries. Like same for computer, we need to learn computer language. First is your software programs. Now computer accounting system runs based on set of instructions. Yes, now when you are using your computer accounting system, there you are going to use some set of instructions. Correct? Then programmer, a person who develops the computer software. See, everyone cannot develop it. Yes, like everyone cannot do the surgery. Yes, like for surgery we require doctor, and that too specific surgery doctor. Like that, for developing the computer software, we require the experts, and those experts are known as programmer. Now, next is computer software. So the instructions of the programmer are in a computer language in the form of computer program. Yes, so this is your computer software. Then what are the accounting softwares we are using nowadays like COBOL, FoxPro, etc. Okay, or on operating platforms such as Windows, Unix, etc. So these are the computer language, like who is the person who develops the computer software, known as programmer. Now, what is this computer software program? This is the computer accounting system, which runs based on the set of instructions. Like in your bank, you are using some, applications. You are using some softwares. So that software is as per your bank requirement. Hana, if you shift your bank, there they are going to use different softwares. So that is what computer programs. Now, next, we have different types of computer. First is your analog computer. Then next is your digital computer. Now, analog computer means what? Here, analog computers are mostly used in scientific and mechanical fields, and they process data in a continuous form. Yes, so analog computers, here what they are using, here they are using scientific and mechanical fields. So basically this is used in engineering side. And next one is your digital computers. Now they accept data, convert them into a useful results by carrying out arithmetic operations. Now for passing accounting, yes, for preparing balance sheet, P&L, we are going to use this digital computers. And if you combine both digital as well as analog computers, this is going to create hybrid computers. This is your third type of computer. And hybrid computers, this is the combination of digital plus analog. Digital plus analog. Yes. So this is these are the different types of computers. Now, next, there are different terms which we need to use in our computerized accounting. Like first is our data, then next is record, data file or file, and system. So these are the different terms we are using when we are saying that we are doing computerized accounting. Data means here you are going to collect different bills, invoices, yes, about transactional details. That is your data. Then you are going to record in your system. Yes, you will maintain proper file, day wise file, month wise file. That is the record. And in that you have the different data file. Yes, and you are storing at some particular place. That is a system. So these are the terms used in computerized accounting. Then next we have omni-channel banking. Now omni-channel banking means what? This provides the same set of services to customers across all channels. Omni-channel banking, here your banks are using two things together. First, they are using branches. Yes, here they are using branches along with apps. Yes, if your bank is using both the things, physical as well as digital thing, then that is omni-channel banking. Like if you see SBI, yes, State Bank of India, they have their own branches, yes, and they have their own app. Yes, they have their own app, that is, correct. So if that is what your bank is providing, means they are using omni-channel banking. Now here, omni-channel platform can improve marketing performance, increase customer retention, and simplify onboarding processes. So this is your omni-channel banking. Then users can access all banking service via website, mobile app, bank branch, call center, or even social media platforms like WhatsApp, Facebook, or Instagram, or any other available channel. Now, so many banks are saying that if you want to inquire about your balance, just give the reply on this number. We will provide WhatsApp text. Yes, um, just WhatsApp us. We will provide you bank statement. Just WhatsApp us. We will provide you so many, whatever the possibilities they can provide through WhatsApp. So that is what omni-channel banking. What they're using, omni-channel banking. Then next you have neo banking. Neo banking means what? Is a bank that operates without a physical branch. Means here we are not having any physical branch. Yes, no physical networks we have. All the things we are doing through our what? Through our this neo this through digital platforms. Yes, so here neobank is a bank that operates without a physical branch network. The banking business is conducted entirely online. So the concept of neobanks has become appealing to tech savvy people. Now everyone is so busy in their life. Yes, they are having very less time to visit banks for every activity. Yes, for suppose bank statement, no one wants to visit bank. Yes, for loan, yes, no one wants to visit bank. FD opening, all this PF opening, no one wants to actually visit bank. So now what banks are doing, or this different providers are doing, they are opening totally digital bank. Yes, while sitting home, you can open your bank account, you can take loan, you can create your investments. So if your bank is doing everything online, no physical branch, then they are using neo banking. So what are the advantages? simple account opening procedure, and that is lower cost for bank as well as for this customers. Yes, banks, there is no requirement to arrange infrastructure. Yes, there is no requirement to arrange building, no employees, nothing. And same for customers, there is no requirement to travel. Yes, so this is the cost saving part for both the parties. So this is your neo banking, and remember, this is very important. In exam they can ask direct questions based on neo banking and omni channel banking. Now we have seen about computers and few important banking channels which we are using now. So let's solve few questions based on this. What is the computerized accounting system? A. System that captures business transactions manually. No, manually. Yes. B. A system where accounting functions are performed using computers. See, a system that only prepares financial report. Only financial report. No. System that ignores accounting standards. Then how come you can say you are preparing financial statements? So correct answer here is your answer D. Because computerized accounting system, they need to uh, pass daily transactions also. Yes, then they need to prepare financial statements also by complying with Ind AS and AS. And finally, if you want any other type of reports, various reports you can prepare through your software. And these things are done not manually. Yes, you are using some software. So the correct answer is answer B. Next, what is a neobank? A bank that operates entirely through physical branches? No, a bank that operates without any physical branches and conducts business online. We can say this is correct, but let's read other options. C, a traditional bank with both physical and online transactions. No, then this is your omni-channel now. So this is also not your answer. Then a type of investment bank focused on digital assets. No, correct answer is answer B. This is your answer. Okay, then next. Who is responsible for developing computer software for accounting systems? Accountant, programmer, administrator, auditor. See, who is developing your computer software? Programmer. Yes, they are the experts. Not accountant, not administrator, not auditor. Correct answer is your answer B. This is your B answer, not C. Then, what are the physical components of a computer system called? Software, hardware, data, algorithm. Physical components of a computer system are called very easy, that is hardware. Yes. Then, which of the following is an example of computer peripherals? Keyboard, printer, disk drive. Disk drive. So correct answer is all of the above. Yes, these type of questions only they're going to ask from this unit, and this question is I think from your IFBF book only. Before we start the theory part, let's talk about few points related to business. Now if I ask you about like how to start a business. Yes, suppose if you want to start a business, you require funds. What is the first thing we want? We want funds. Without funds, can we start any business? No. First, we need to arrange funds. Correct? First, we want money. Then only we can start. We need to purchase goods. Yes. We need to take the property on rent. Yes. We need to appoint employees as well. We need to purchase assets as well. So first thing that we want, that is funds. But how we can arrange these funds? So we have two options. First, suppose you are starting your business. So how you will arrange your funds? Suppose you have some savings. Yes, your FD, your saving account. Yes, your jewelries you will use. So first you will use your savings. Yes, so whenever you are using your own funds, that will be your equity fund. Means when owners are giving any amount to their company, that will be equity fund. Yes, that is equity fund. But suppose you want more extra fund, then what you can do? Then what you can do? Just think, you can take bank loan. Yes, you can take bank loan, and this bank loan is known as debt fund. Yes, so basically we have two types of funds: equity, debt. Equity, owner's amount; debt, borrowed amount. What you can say, debt means your borrowed amount. Yes, your borrowed amount. Now there are so many ways through which you can do borrowing. First, you can take bank loan. You can go with debentures. Yes, you can issue bonds. So basically, bank loan, when you take from bank, like as you have taken loan from SBI, Axis Bank, ICICI Bank. Yes, debentures, bonds, which when you issue to public, means when you're taking public loan. So that is your debentures, bonds. Okay. So these are the two ways through which you can arrange funds, and then you can start your business. Through this, you will purchase machines. Yes, you will purchase your stock. You will generate your income based on this funds. Now, there are different ways and the different forms of organization. Correct? So first we have that is sole proprietorship. Like uh, yes, you can see nearby your shops. Yes, that medical shop, that confectionery shops. Yes, so there is a single person who is manager, who is labor. Yes, who is the owner of that shop. Correct. So that is sole proprietorship. Then next is your partnership firm. When two persons are coming together and they are working for their common goals, that is what partnership firm. Then next you have limited liability partnership. Now, limited liability partnership is the combination of company as well as partnership. Here you will see partners are coming. You and your friend both are working, but they have some limited liability. Limited liability means whatever amount they have invested, only they are liable for that much amount. Yes? Then next you have Hindu undivided family. So basically, if you're from Hindu family, Sikh family, Jain family, you can start your HUF. Yes, this is one of the way through which you can do your business. Then even is your AOP and BOI, association of persons or body of individuals. Association of persons mean when you are combining like Mr. A, yes, then Reliance Industry, then Tata Company, yes, plus Mr. B. So if these type of person you see and they are coming together for any business or for any working, then that is AOP. But if you talk about body of individuals, means if you see Mr. A, Mr. B, Mr. C only, yes, when individuals are coming, like you and me, all are coming together, natural human beings are there, then that is body of individuals. Then next is your company. Company like your Reliance, yes, Tata, all these are your companies. Then cooperative societies. So cooperative societies is like your NGOs, yes, who are doing they're working not for any profit motive. Correct. So these are the different forms of business, or you can say organizations. Now coming to the next part, that is financial decisions in a firm. Now, what are the decisions you will take in your organization? First, you will estimate how much capital you want. Yes, suppose here you want to start toy manufacturing. You want to start this business. Yes, you want to start your business. So, what first thing you will see and what first thing you will talk? How much amount we need to invest? Correct. Suppose you decided that 10 lakhs at least we want for starting this manufacturing, this business. So this is your estimating the capital requirement. Now next thing we will talk about deciding the capital structure and composition. Means for starting this toy manufacturing we require 10 lakhs. But how we will arrange this? Yes, suppose now we have understood that 4 lakhs we will use our own saving and 6 lakhs we will borrow. Yes, we will borrow. Correct? 4 lakhs owner will bring and next 4 lakhs owner will bring and 6 lakhs they are going to borrow. So this is the structure they are framing. Then deciding on sources of funds. So sources of funds, like how they can borrow the 6 lakhs. They've identified that they will take from SBI bank loan. Yes, they will take from friends loan. Correct? Then they will issue debentures. Yes, etc. So means you are identifying the sources. Now your savings. Now you have identified you will use your FD, your PF amount. Yes, etc. So that is your sources. Next, use of long-term funds. Long-term funds means, see, long-term means which you are going to use for more than 12 months. Yes, suppose you have taken bank loan. Correct? Suppose you have taken bank loan for 5 years. Now, from bank you have taken suppose rupees 20 lakhs. Yes, so what are the uses of this 20 lakhs? You will purchase machine. Yes, you will purchase equipment, you will acquire land, factory. So these are the sources which you need to check. So this is your use of long-term funds. Then corporate strategy, mergers and acquisition. Like what plans you will make. Yes, for upcoming 6 months, for 6 months, for 12 months. When you're talking about plans, that is your corporate strategy. Then next we will talk about use of short-term funds, working capital management. Basically, when you are starting a toy manufacturing, every day you will manufacture, you will sell your toys, you will purchase the raw material. Yes, so your working, your routine, your operational requirements is your working capital. And what funds you will use for this? You can take overdraft from the bank. Yes, from this overdraft, from this amount, you will purchase raw materials. Yes, you will pay salary. So that is what use of your short term funds. So these are the financial decisions in a firm you need to take. Now next point is, what are the objectives of financial management? Now why we are doing this financial management, what actually it will help you in? So first is your to ensure adequate and timely support and supply of funds. Yes, when you are managing, when you are arranging, yes, when you are identifying the sources, your amount that you require, so basically you will get the adequate amount on time. On a timely basis you will receive the funds. Then you can decide your capital structure also, how much you will borrow, how much you will bring your own funds. Then you can see the compliance with regulations also, like if any income tax regulation is there, a GST regulation is there, income tax regulation is there, you can comply with that particular law as well. Then last one is your to ensure appropriate financial risk management. See, in every business you will identify the risk. Now how to manage those risks, that is the important part. Correct? So before you start your working, you will talk about all these things. So that is your management of your risk also. Sometimes you can see there is a deficit in your business related to your funds. So how you will arrange that time, that is also one of the risks you will cover while talking about objective. Okay, so these are the few objectives. Now, next we are going to talk about fundamental principles of finances. First, we are going to talk about time value of money. Time value of money means whatever amount you are receiving today, that is more valuable than the amount you will receive tomorrow. Yes, like if we talk about Parle G, this is one of your biscuit. Now, if earlier, like in 2010, if you if you would have paid rupees 10, you could have purchased that time 10 biscuits. Yes, 10 biscuits of this Parle-G. But today, when you are giving rupees 10, you are receiving only 5 biscuits. Yes or no? So now you can see, for the same value, for the same amount of value, you are getting small amount. Yes, you are getting small quantity, smaller quantity. Earlier you used to get larger quantity, higher quantity, but now smaller quantity. So that is what time value of money. So a rupee received today is more valuable than a rupee received in the future. Then next, opportunity cost of money. Now opportunity cost of money means, suppose you receive 4 options. Yes, after clearing your college, you got 4 options. Or let's talk about 3 options you have received. First job offer you have received from bank, then you got the next offer from government office, then some private job you have got the job offer. Yes, and what are the packages? Let's talk about, in bank you're receiving 15 lakhs per annum, government 10 lakhs per annum, and private suppose 12 lakhs per annum. So now tell me which option you will opt, which is the package you will select. Of course the bank one, है ना, because there only you are receiving the highest amount. And which is the next best alternative for you? Which is the next best option? Yes, that is your private one. Correct? So when we are talking about the next best opportunity, yes, that is your opportunity cost. Your next best opportunity is your opportunity cost. Okay, so it implies that if a person deploys his money on one investment, then he has to give up the opportunity to put this money on some other investments. Suppose, now let's take one more example. Suppose I have rupees 10,000 rupees. Yes, I have the option to invest on stocks or to purchase jewelry. Yes, if I'm purchasing jewelry, means I have actually foregone the option, the return from the stocks. So the amount that I have foregone, which I would have received from the stocks, that is what opportunity cost of money. Correct? Then last, not last, next is your risk and return. Now risk, whenever you invest in your stock market, we have the risk. Yes, we have the risk. Then return, how much amount you are receiving, that is what return. If you invest in Reliance Industries, how much amount you will receive? Suppose 10,000. If you are investing in 100 rupees you are earning, so that is your return. Correct? Risk means you can see the, you can face the losses, so that is what risk. So these are the few fundamentals about your principles of finance. Now next, building blocks of modern finance. Now this is important. You have 4 building blocks of modern finance: planning, what we need to do in future. Next, decision making, you are examining your point of view. Correct? You are taking decisions. Suppose you have 4 options, A, B, C, D. So when you have 4 options, which option is best for you? Correct? You will do the cost analysis, you will do the revenue analysis, and then you will select any particular field. So that is what decision making. Then organizing and directing, how to implement the decision that you have selected. Correct? So here you will develop your organization. Here you will develop your departments. Yes, who will lead? Who will be the manager here? That is what directing. And controlling means, here you will uh, actually calculate your standards with your actual. And standard means your budgets. Whatever decisions, or you can say whatever plans you have made, you will compare with your actual. And whenever you find any deviations, you will take corrective action. So these are the 4 building blocks of modern finance: planning, decision making, organizing, directing, and controlling. Now, next in this only you have required rate of return. Now required rate of return means what? as an investor, how much return I want if I'm investing any amount. Suppose this is a Reliance industry. I am investing 1 lakh. I am investing 1 lakh. How much return I want from this company? How much profit I want from this company? That is what return. First thing what I will ask from this Reliance industry, that is my risk free return. Risk free return means what? Means if I invest this 1 lakh, yes, in FDs, I could have received 6% per annum. Yes, this is the return I can get. So this is the risk free return because there is no risk. But as I am investing in this Reliance industry, there are so many risks. Yes, market risk, company risk. So because of taking the risk, I want some advantages. Yes, I want some premium because of this risk. So I want this two things from Reliance industry. That is what required rate of return, the risk free part along with risk premium. Now how you can calculate the risk? With you have standard deviations. Higher the risk, higher the return I want. Yes, higher the risk premium I want. So this is your required rate of return. The firm has to decide on the rate of return it wants on its investment, below which it would not like to invest its money. Yes, total I want above, suppose 6 plus risk premium amount. Below that I will never invest in that company. So that is your required rate of return. Next you have social responsibility. Now you must have heard about CSR activities, corporate social responsibilities. Big companies, they need to comply with this social responsibilities because they are using society's resources. Yes, they are depleting our environment. So they need to provide some benefit, correct? So they need to comply with some social responsibilities. So basically we have four categories: environmental, philanthropic, ethical, and economic responsibilities. For example, companies could have arranged blood donation, cataract surgery, medical checkup, yes, implementing child labor laws, or collection recycling of plastic waste, creating food bank, providing night shelter to homeless persons, sport complexes, providing safe drinking water. So these are the some examples which companies can use for social responsibilities. But we have one section, that is section 135. As per that, if companies are complying with CSR, they need to especially check this legal aspect. So the first point is, if company is actually statutorily required to spend. If companies needs to comply with CSR, then they need to give at least 2% of their average net profit. Yes, 2% of average net profit. Now, how to calculate this average net profit? For calculating average net profit, they need to take 3 years previous financial year profit, and with this they will calculate current financial year CSR. Yes, most of the companies in India, they need to comply with this CSR, and as per that at least 2% of their average net profit. Now how to calculate average net profit? By taking 3 previous financial year's data to calculate current year CSR amount. Yes, and companies, if they are complying with CSR, they need to disclose the activities, their detail, and where they are complying it. So as in their board report also they need to show this. And as per section 135 of the Companies Act, they need to comply with CSR activities. Yes, so with this we have completed your overview of financial management. Now let's talk about and let's solve few questions. Which of the following is a part of financial management decisions? Investment decision, financing decision, dividend decisions, or D, all the above? Tell me. Can you tell me the correct answer? Here, Which of the following is a part of financial management decision? Tell me. Financial management decision will be taking investment decision, dividend decision, or financing decision. Tell me, what do you think? Which is the part we need to comply with? See, which of the following is a part of financial management decision? As a financial management decision, we are going to talk about investment decision also, financing decision also, and dividend decisions also. So all of the above. Then next, what is an essential component of organizing and directing in financial management? Tell me. What is an essential component of organizing and directing? Providing the right leadership, ignoring decision making, reducing planning time, avoiding organizational structure. All these three things are talking negative. Yes, and when we are implementing something, we require right leadership. So correct answer is answer A. Next, the function of financial controlling involves what? Continuous monitoring of activities, stopping after decision making, ignoring deviations from the plan, avoiding financial records. So what is the function of this controlling? Here you will set your budgets or you will use your plan with your actuals. You will compare, and if any deviations are there, you will control it. Yes, so the correct answer is continuous monitoring of activities, stopping, ignoring, avoiding. Again, all these three things are negative. What does opportunity cost refer to? The total amount spent on an investment, value of the next best alternative foregone. Answer B is your correct answer. So, with this, we complete your today's unit daily. So, first, let's talk about what is this ratios. So, for this, let's take one example. Suppose I am saying this is a Reliance industry, and if I am investing 1 lakh rupees, yes, if I am investing 1 lakh rupees, after 1 year, I can earn profit equal to 10,000. Yes, 1 lakh I invested in this Reliance industry, and the return after 1 year I'm going to receive, that is 10,000. Correct? So here everything is given in absolute figures. Yes, 1 lakh, 10,000. So these figures are very easy. On the other hand, if I'm saying I invested 1 lakh but I earned 79823.33 something, then that is going to be very difficult. Yes, like what is actual return that you are earning? So every time you are taking absolute figures, that will be very difficult for. But if I'm saying that I am earning profit equal to 10%, you can understand easily. Yes, means whatever amount I'm going to invest, I will earn 10%. If I invest 2 lakh, I will earn 10%, means 20,000. Yes, if I invest 3 lakh, I will earn 10%, means that is 30,000. So if I am getting the ratios in place of absolute figures, things are becoming much easier. Yes, because you can use for smaller data as well and for bigger data as well. So that is the benefit of this ratios. Ratios uses the relationship which you can apply every time when you are seeing the data. Correct? Always calculating from a smaller data, bigger data, that is very difficult. Yes, no one is having that much time. So always we try to simplify the things. So how we simplify the things? Through setting some relations. And how we have used this relations? By using ratios. Yes, you can easily get any idea whether you invest 10 lakh rupees, 15 lakh rupees, or 10 rupees also. With the help of 10%, you can calculate the profit for each and every cases. Yes, so this is what the meaning of ratio. But here we are going to talk about accounting ratio. So accounting ratios, again this will talk about the relationship which we are going to express in mathematical terms, and between accounting figures which are connected with each other in some manner. Generally, when we are talking about accounting ratios, we are going to use your financial statement. Yes, and what are the things we include under this financial statements? That is your balance sheet and profit and loss account. Balance sheet talks about your financial position. Yes, this talks about your assets and liabilities. On the other hand, P&L talks about your profit or loss that you have incurred during the financial year. So when we are talking about accounting ratios, we are going to use a balance sheet and P&L account. Yes, but while setting the relationship to make the things simplified. Yes, so this is the meaning of accounting ratios. Now, what are the uses? Things are going to be simplified. Yes, simplify financial statements. If I'm saying I'm earning profit, that is 15%. Yes, so whether if I earn 1 lakh, yes, whether I invest 2 lakh, whether I invest 3 lakh, I know about my profitability. Yes, I will just multiply with 15% and I will calculate the absolute figure. So this 15% gives me the simplified financial statement. This talks about the simplified version of my this financial statements. Yes, this helps in to facilitate inter-firm comparison. Suppose if I am having 1 lakh rupees, yes, now I want to invest. So I have two companies. One is your Reliance, one is your Tata company. Now, if I talk about your profitability ratio, so with this I've understood if I invest 1 lakh, Reliance will give me 15% return, whereas Tata will give me 20% return. So as a rational investor, in which company I'm going to invest? Of course, in Tata company. Yes. So this is how I can use the accounting ratios for inter-firm comparison. Correct. Next is your intra-firm comparison. Comparing your own company. Means this is your Reliance industry and I invested in previous year. Yes. So that year the profit I have seen that is 10%. Current year, your profitability is around 15%. Next year, we are expecting we are going to see 20%. So you can see there is a growth in your profitability. This is also you can use in case of intra-firm, means same company. Within the same company, when you're comparing previous year, current year, future year, you can use this ratios. There is no requirement to use again and again your this absolute figures. Correct. And last is helps in planning. Now, how to plan about future, what strategy to opt. Yes. So these are the uses of accounting ratios. Now, we are classifying ratios into two parts. First is your traditional classification. Next is your functional classification. Now, under traditional classification, profit and loss account ratio, balance sheet ratio, composite or interstatement ratios. Profit and loss account ratios means we are going to use profit or loss. Yes, profit and loss account ratios, you're going to use profit and loss. Balance sheet ratios, here you're going to talk about your assets and or your liabilities. Yes, with this you are making your comparison. Composite means you're going to include your both the things, that is your balance sheet as well as your P&L account. But this three methods which you have seen under traditional, this one is your old ways. Yes, this is your old ways. Now we are not using this. Now we are using functional classification. Now, under this functional classification, as per the functions, we are deciding the ratios like profitability ratio, turnover activity ratios, financial or solvency ratio. Now, this again divides into two subparts, that is short-term solvency or liquidity ratio, or B, long-term solvency or solvency ratio. Yes, so these are the three major classification under your functional classification: profitability, turnover, and solvency ratio. Now again, under this solvency ratio, we have two subheads: short-term solvency ratio or liquidity ratio, long-term solvency or solvency ratio. Okay, so these are the classification of your ratios. Now, let's start with the first ratio, because see, in your bank, the most widely used ratios is your this current ratio. Okay, after this you are using this liquidity ratio, DSCR ratio, yes, earning per share ratio. So let's talk about these ratios. So first one is your current ratio. Current means we are talking about present. Yes, always remember, current means we are talking about present. At present, what's going on? That is what we are going to calculate. So, this ratio indicates that the firm's commitment to meet its short-term liabilities. Now, short-term liabilities means liabilities whose life is less than 12 months. Yes, less than 12 months. Like for 1 month, 2 months, 3 months. So that is what current ratios. Yes, whenever you are talking about your at present moment, yes, that is your current you are going to use. Now, here you need to use one formula, that is current assets divided by current liabilities. So basically, as per this equation, as per this formula, we are identifying about your current situation, that whatever you are doing, yes, whatever you are owning, whether that is actually, you can use it for recovering your obligations or not. Yes, that is what current ratio talks about. So basically, here we are going to take current assets. What are your current assets? Like your cash, inventory, yes, your routine activities, then your debtors, yes, etc. Then what are your current liabilities? Liabilities, that is your obligation, like your short-term loan. Yes or no? Short-term loan, bank OD, yes, etc. So if you're paying less than 12 months, then that is your current liabilities. Same, your cash, inventory, debtors, which you're going to use in your regular day-to-day activity. So basically, if we talk about your cycle, yes, first you arrange cash. For starting your business, you arrange cash. With this, you purchase your raw materials, yes or no? And then you will do the production. Then you will do production of this raw material to convert it into finished goods. And then you will sell. And after selling, your customer will pay you again cash. So whole this activity, whole this cycle is your working cycle. Yes, this is your working capital cycle. So basically, when you're talking about this cycle, this is your current cycle. Yes, your daily activity, your operational activity cycle. So whatever you are doing on your operational, operational days, that is your current thing. Now, for calculating the current ratios, you are going to use current assets divided by current liabilities. Means whatever assets you are owning, like cash, inventory, raw material, finished goods, yes, the cash you are receiving from the customers, that is your current assets. Whether this current assets are enough to repay your current liabilities, yes or no. That is what current ratio talks about. Current liabilities like short-term loan, bank OD, yes, borrowing from your friend for 1 day, 2 day, 2 days, yes, then market securities whose life is less than 3 months. So that is what current liabilities. So if I say I have 500 current assets divided by 300 current liabilities, means here I have current assets, means I have, asset. This is my current asset and this is my current liabilities. So I can recover 300, and after recovering or after paying this current liabilities, I am going to see my working capital, that amount which I can reinvest in my business. So that is what your current asset minus current liability talks about. Means I have current assets 500. If I pay my current liabilities, then also I can see my working capital, that is 200. Yes, so this is your relationship between current assets and current liabilities. Means easily you can repay your current liabilities with your current assets only. So here current assets include cash and convertible assets. Convertible current liabilities includes liabilities payable within a year. And what is the satisfactory ratio we have? Your ideal ratio is going to be 1.2 to 2. Yes, the ratio of current ratio needs to be between 1.2 to 2. Now here your working capital is what that you are using for running your business. Yes, you are using this amount for running your business. That is what working capital, or you must have heard about net working capital also, after subtracting current assets minus current liabilities. What is the formula for current ratio? Current assets divided by current liabilities. So this is about your current ratio. Let's do the practice. Company has current assets of 1,20,000. Current ratios 60,000. What is your current ratio? Current ratio equal to current assets divided by current liabilities. 1,20,000 divided by 60,000. So 1,20,000 divided by 60,000. This is your 2:1. Yes, your correct answer is answer C. That is 1,20,000 divided by 60. Okay, means your current assets are 2 times more than your current liabilities. Means you can recover your liabilities and then also you will be seeing some excess amount. Yes, so this is your current liability. Let's calculate one more. Current ratio is equal to your current assets divided by current liabilities. In this question, current ratio is 2:1 and current liabilities are 80,000. What is the current assets? Now, these type of questions they are asking in exam. Then they are giving the current ratio like 2:1 and current asset is a missing data and you have current liabilities that is 80,000. So your current asset is going to be just do the cross multiplication. So this is going to be your 1,60,000. Yes, correct answer is answer D. These type of questions they are asking in exam. Okay, now coming to the next ratio, that is a liquidity ratio. Now liquidity ratio means how fast you can arrange your funds. Yes, suppose in case of emergency you want 10,000 rupees, how you can arrange your 10,000 rupees from your bank, from your cash. Yes, if you hold any securities you will sell on your stock market. So how fast you can arrange your cash in case of emergency, that is what liquidity ratio talks about. You can call this liquidity ratio as acid test ratio or quick ratio. Now this is important in exam. They ask even question based on their names. Yes, what are the other names of liquidity ratio? Acid test ratio, quick ratio. Yes, acid test ratio and quick ratio. As per this, you are calculating how fast you can arrange your funds. So remember here you are going to use your liquidity ratio. Liquidity ratio. So liquidity ratio equal to liquid assets divided by current liabilities. Current liabilities whose life is less than 12 months. But what is this liquid assets? See, how to calculate liquid assets? Current assets, just now we have seen, minus your inventories. Minus inventories, prepaid expenses, and if you have paid any advance tax. Means inventories. Now if I'm doing toy manufacturing, yes, toy business, and this is my inventory. Yes, toys which I am holding in my godown, that is my inventory. So can I immediately convert this raw materials toys into my finished goods, or I can sell it? No. For selling this toys, I require customers. Yes, unless and until I'm not getting any customers, I cannot convert it into cash. So that is the reason inventories are not your liquid assets. Now, prepaid expenses. It already means you have paid your suppose rent paid, yes, advance rent paid for 5 months, 6 months, means I have already paid it. Just now I will utilize the benefit. I'm not going to receive any cash. I'm just going to receive benefit. Yes, so that is again we are going to subtract it. Then advance tax. while paying TDS, yes, while paying TCS amount. So that is the advance tax we are paying. Yes, so already you have paid it. Can you receive afterwards this tax? No, unless and until you are filing your income tax return and if you are receiving any refund. Otherwise, there is no guarantee of receiving this advance tax. Correct? So from current assets, we need to subtract these three things. Inventories, prepaid expenses, advance tax. So this will give you liquid assets, okay, divided by current liabilities. And what we need to subtract? Prepaid expenses, stock, or you can say inventories and advance tax. Generally, we say quick ratio. If equal to 1, that is going to be satisfactory ratio. Now, let's solve a question based on this. Current assets equal to 1,50,000, inventory 50,000, prepaid expenses 10,000, current liabilities 60,000. What is the quick ratio? Quick ratio equal to current assets minus inventory minus prepaid expenses divided by current liabilities. So current assets equal to 1,50,000 minus 50,000 minus 10,000 divided by 60,000. So what is your quick ratio? 1,50,000 minus 60,000. So this is your 90,000 divided by 60 divided by. So your correct answer is 1.5 divided by 1. Correct answer is your answer A. Okay. Let's solve one more ratio. Cash equal to 40,000, marketable securities equal to 20,000, current liabilities 80,000. What is the uh, cash ratio, or you can say here quick ratio? Yes. So what is your quick ratio here? Again, always remember, if inventories, prepaid expenses are not given, just add whatever assets you can see. Yes, in your current site. Add your cash plus marketable securities divided by current liabilities. So that is your 40,000 plus 20,000 divided by 80,000. So 60,000 divided by 80,000. 0.75 is to 1. So this is your satisfactory ratio. The answer is no, because we want quick ratio above 1. Yes, we want above 1. So this one is your satisfactory ratio, but this is not your satisfactory ratio. Okay, this is your answer. Now, let's solve one question based on your data given here. Now, this type of questions they are asking in exam. So, ABC Limited is a medium scale manufacturing company engaged in the production of consumer durables. Consumer durables. The finance department of the company is evaluating its short-term financial health for the year ending March 25. Now, the company has reported the following financial data. So inventory, trade receivables, cash bank, short-term, prepaid, current liabilities. Based on the above data, identify the correct current ratio and quick ratios. So we need to calculate two things. First, let's calculate current ratio. Current ratio equal to current assets divided by current liabilities. So current assets, you are going to add inventory, yes, trade receivables, cash, plus short-term investments plus your prepaid expenses divided by current liabilities. So here add 6 lakh plus 8 lakh plus 2 lakh plus 4 lakh plus 1 lakh. This is going to be your 21 lakh divided by 10 lakh. 6 lakh plus 8 plus 2 plus 4 plus 1. Yes, that is a 20. That is your 21. So your current ratio is your 21 lakhs divided by 10 lakhs. This is your 2:1. Yes, 2:1. Now let's calculate quick ratio. What is the quick ratio? Liquid asset divided by current liabilities. Now see, for calculating liquid asset, you can go with two things. Either go with A1 or you can go with the B1. So in case of calculating liquid assets with A, use your current assets minus your inventory minus prepaid expenses. Yes, so means current assets equal to 21 lakhs minus inventory 6 lakh minus your prepaid expenses, that is your 1 lakh. So this will give you 21 lakh minus 6 lakh minus 1 lakh. That is your 14 lakh. Now you can do addition just by taking trade receivables plus cash and bank balance plus short-term investments. See, 8 lakhs plus 2 lakh plus short-term investment, that is 4 lakh. 8 plus 2, 10 plus 14. See, both the ways you can use for calculation. Both will give you the same answer. Yes. So liquid assets equal to 14 lakhs divided by current liabilities going to be same, that is your 10 lakhs. So 14 lakhs divided by 10 lakhs equal to 1.4:1. Yes, so this is how we need to calculate current assets and quick ratio. Okay, now we have one more very small ratio which you are going to see again and again, that is your earning per share. Now, earning per share EPS tells about the earning per equity share. Means if you are investing or if you are purchasing one share, what is the return you are receiving? Yes, in your one share, if you purchase of Reliance, what is the earning you are receiving? So that is what earning per share. Net profit after tax and preference dividend divided by number of equity shares. Means if you purchase one share of your company, of that any company in which you have invested, what is the return you are receiving? That is what earning per share talks about. Yes, so here your earning per share formula is net profit after tax and preference dividend divided by number of equity shares. So first you calculate profit before, or you can say first you get earning before interest and tax. From this you subtract the interest amount. From this you receive profit before tax. Finally you subtract the tax amount and then you receive profit after tax. You subtract the preference dividend and finally whatever the earning is available, this belongs to your shareholders. Yes, we're talking about this earning, but this earning is given in total. We need to calculate per share. So how we can calculate? By dividing by number of equity shares. Okay. Let's solve one question. So net profit after tax 5 lakh, preference dividend 50,000, number of equity shares 90,000. So earning per share equal to net profit after tax minus preference dividend divided by number of equity shares, means ultimate amount available to your owners. So 5 lakh minus 50,000 divided by 90,000. 5 lakh minus 50,000 divided by 90,000. Correct answer is 5. Means if you purchase one share, you will receive 5 rupees earning. That is what earning per share talks about. Okay, let's solve one more question. If a company reports a net income of 10 lakhs, issue 2 lakhs equity shares with no preference dividend, your earning per share is going to be net income divided by number of equity shares. That is your 10 lakhs divided by 2 lakh. So your answer is 10 lakh divided by 2 lakh. Again 5. Yes, earning per share is of 5. If you invest one share in this company,